January 3, 2026. Put that date in your calendar, because historians are going to be writing about it for the next 50 years. While you were likely recovering from New Year's celebrations, the global energy map was being violently redrawn. We aren't talking about a trade deal. We aren't talking about sanctions. We are talking about the most aggressive corporate takeover in the history of the world, enforced by the United States military. In an audacious strike that shook the foundations of South America, the Trump administration decapitated the leadership of Venezuela, removing Nicolás Maduro from power. But that was just the opening move in a much larger, much more dangerous game. As we speak, American Navy destroyers are sitting off the coast of the southern Caribbean. They aren't just patrolling, they are seizing assets. Venezuelan oil tankers, vessels carrying millions of dollars of black gold, are being intercepted and redirected. Why? Because Donald Trump has decided that the world's largest oil reserves, larger than Saudi Arabia's, larger than Russia's, are no longer going to sit idle, and they certainly aren't going to flow to China. He wants them back on the market, and he wants American companies to run the show. But here is the mystery: you would think Wall Street would be celebrating. You would think the CEOs of ExxonMobil and Chevron would be popping champagne corks. They aren't. They are terrified. The president is demanding a $100 billion investment to rebuild a broken nation. He promises it will create tremendous wealth for you, the American shareholder. But the oil executives? They're looking at Venezuela and seeing a money pit, a trap, and a geopolitical nightmare that could blow up your portfolio. Today, we are peeling back the layers of this high-stakes gamble. We're going to look at the physics of heavy crude, the broken infrastructure of PDVSA, and the gun-to-the-head diplomacy happening in Caracas right now. Most importantly, we are going to explain what this means for the S&P 500, the price of gas at your local pump, and the stability of the US dollar. Buckle up. The oil market just went to war. Let's be clear about what is happening on the ground. This is not normal diplomacy. This is kinetic economics. For the last few weeks, the US Navy has effectively established a blockade around Venezuela's oil terminals. This is the economic equivalent of a chokehold. Venezuela's economy relies on one thing: crude exports. It is the oxygen for their entire system. By controlling the ships, the Trump administration now controls the country's lifeline. Before this blockade, a massive chunk of that oil was heading across the Pacific to China, paying off massive debts Beijing accrued over the last decade. That flow has stopped. Dead. Now, with no other option, Venezuela, under the acting presidency of Delcy Rodriguez, is being forced to sell its oil almost exclusively to U.S. refineries on the Gulf Coast. It's a forced marriage. The U.S. is essentially saying, you will sell to us, on our terms, or you will not sell at all. But Trump's vision goes way beyond just buying the oil. He wants to own the production. On January 9, in a tense meeting at the White House, Trump looked the titans of the American oil industry in the eye: executives from ExxonMobil, Chevron, ConocoPhillips, and told them the holiday from Venezuela is over. He wants them to go back in. He wants them to rebuild. And he's throwing around a number that would make any CFO sweat: $100 billion. His logic? If American engineers and American capital can unlock Venezuela's reserves, we could see oil production levels never seen before. In Trump's view, this floods the market with cheap supply, destroys the leverage of Russia and Iran, and lowers gasoline prices for American voters. It sounds perfect on paper. But there is a massive disconnect between the White House and the boardroom. Darren Woods, the CEO of ExxonMobil, didn't mince words. He called Venezuela uninvestable in its current state. Think about that word. Uninvestable. This is the CEO of a company that drills in some of the most dangerous places on earth, telling the President of the United States, no thanks. Why? Because we have been here before. To understand the fear in the eyes of these executives, you have to look at the history. 20 years ago, under Hugo Chavez, Venezuela was the crown jewel of South American oil. But then came the socialist revolution. Chavez didn't just tax these companies, he stole their assets. He nationalized projects owned by Exxon and ConocoPhillips. He seized billions of dollars of infrastructure overnight. Exxon spent over a decade in international arbitration courts trying to get their money back. They eventually won settlements, but the scars are deep. For a company like Exxon, returning to Venezuela without ironclad guarantees is like returning to an abusive partner who burned down your house, just because they promised they've changed. Trump is saying, go invest $100 billion of your shareholders' money. The companies are asking, who guarantees we keep it? And this brings us to the mixed messages coming out of Washington. Trump told executives the U.S. government would ensure physical security. He's implying the U.S. military or private contractors will protect the oil fields. But then, just 2 weeks later, his own energy secretary, Chris Wright, goes on Bloomberg TV and says the U.S. has no plans to provide security for oil personnel. If you are a CEO, that is a red alert. You are being asked to send your engineers into a volatile, politically unstable country, with no security guarantee, to rebuild an industry that was stolen from you once before. So, why even bother? Why is Trump so obsessed with this specific patch of dirt in South America? Because of the sheer scale of the prize. We need to talk about geology for a second. Venezuela holds the largest proven oil reserves on the planet. More than Saudi Arabia. More than the United States. We are talking about 300 billion barrels of oil sitting in the Orinoco Belt. Despite the green energy transition, the world is still addicted to fossil fuels. Demand is forecast to stay robust through 2050. Control over Venezuelan reserves is essentially a hedge against the future. If you control Venezuela, you control the global spigot for the next 3 decades. But here is the catch, and it's a big one. It's the poison in the prize. Not all oil is created equal. If you drill a hole in West Texas, what comes out is light, sweet crude. It bursts out of the ground under natural pressure. It flows like water. It's easy to refine into gasoline. Venezuela's oil is the opposite. It is heavy and sour. Imagine trying to pump cold molasses through a straw. That is Venezuelan crude. It is incredibly viscous. To even get it to move through a pipeline, you have to dilute it with something called naphtha, an extremely light hydrocarbon. This adds a massive layer of cost and complexity. You have to import the diluent just to export the crude. Furthermore, it's sour, meaning it is high in sulfur. You can't just run this through any refinery. It requires specialized, heavy-duty processing plants. Here is where the wallet connection comes in for the US. The US Gulf Coast is one of the few places on Earth with the complex refineries designed specifically to handle this heavy, sour garbage and turn it into jet fuel and diesel. The US refining system needs heavy oil to run efficiently. For years, we bought it from Venezuela. When sanctions hit, we had to source it from elsewhere, often at higher premiums. Reconnecting Venezuela's heavy crude fields with Texas refineries is an industrial match made in heaven. It's economically logical. But the infrastructure in Venezuela to get that oil out of the ground is totally rotted. Since the nationalizations, PDVSA has been run not by engineers, but by political loyalists. They stopped doing maintenance. They stopped investing. In the late 90s, Venezuela pumped 3.2 million barrels a day. Today? It's scraping by at under 1 million. That is a 70% collapse. It accounts for less than 1% of global consumption right now. Analysts at Rystad Energy, these are the guys who crunched the numbers for the pros, estimate that getting Venezuela back to 3 million barrels a day by 2040 would cost $183 billion. $183 billion. To put that in perspective, that is roughly the entire GDP of Greece. It is a staggering amount of capital expenditure. And Trump wants US companies to foot the bill. If you are a shareholder in Chevron or ConocoPhillips, you need to be asking, is this the best use of my capital? Or should that money be going to dividends and buybacks? This is the central conflict. The White House wants geopolitical dominance, Wall Street wants return on invested capital. Now, let's look at the political chess game, because this is where things get truly dangerous. We have an acting president in Venezuela, Delcy Rodriguez. She is in an impossible position. On one side, she has the US Navy blockading her coast. On the other side, she has the remnants of the Maduro regime and a population that has been fed anti-American propaganda for 20 years. In her State of the Union address on January 15, Rodriguez signaled she is ready to play ball. She proposed legal reforms to open up the oil industry. She is talking about loosening the grip of PDVSA, the state-run monopoly. She is effectively offering to reverse the policies of Hugo Chavez. This is a desperate move to save her economy. She knows that without US technology and US capital, Venezuela starves. But Trump isn't making it easy for her. In an interview with The Atlantic, he used rhetoric that sounded more like a mob boss than a diplomat. He said, and I quote, "If she doesn't do what's right, she is going to pay a very big price, probably bigger than Maduro." That is a direct threat to her life. This creates a highly volatile environment for any business. If you are Exxon, and you see the host government is only cooperating because of a gun to their head, you know that the moment the gun is removed, the deal is off. That is not a stable investment climate. That is a hostage situation. And then there is the China factor. For the last decade, while the US was sanctioning Venezuela, China and Russia moved in. They loaned billions to Caracas. They sent engineers. They took payment in oil. Trump's plan is explicitly designed to keep China and Russia out of America's backyard. It is a resurrection of the Monroe Doctrine, the 19th century policy that stated the Western Hemisphere is off limits to European powers. By forcing Venezuela to sell to the US, Trump is cutting off the flow of oil to China and stiffing them on their debt repayments. Beijing is furious. Moscow is watching its assets become worthless. If the US companies move in, they aren't just drilling for oil, they are planting the American flag. This makes their facilities targets. If a pro-Maduro insurgency begins, or if foreign operatives decide to stir the pot, pipelines are very easy to blow up. We saw it in Iraq. We saw it in Nigeria. We could very easily see it in the Orinoco Belt. This is why the security question is so critical. Without US troops on the ground, who protects the Exxon engineers? The Venezuelan army? The same army that was loyal to Maduro 3 weeks ago? It is a recipe for disaster. Let's step back from the politics and look at the market reality. What are the companies actually doing? Chevron is the outlier here. They are the only US major that never fully left. They have been operating under a special sanctions waiver from the US Treasury. They currently pump about 240,000 barrels a day. Chevron has pledged to boost that by 50% over the next 2 years. They are already on the ground. They have the logistics in place. For them, this is an opportunity to scale up what they are already doing. But for everyone else, Exxon, Conoco, Shell, BP, the barrier to entry is massive. They are demanding 3 things before they spend a dime. 1. Rule of law, they need a legal framework that prevents future nationalization. 2. Regulatory changes, they need control over hiring and procurement, bypassing the corrupt PDVSA bureaucracy. 3. Long-term agreements, they need contracts that last 20 or 30 years to recoup that $100 billion investment. Exxon has explicitly stated they need an explicit invitation and durable reform. They are playing hardball. They know Trump needs them more than they need Venezuela. There is also a massive labor shortage to consider. The Venezuelan brain drain has been severe. The talented engineers, the geologists, the project managers, they all fled the country years ago. They are driving Ubers in Miami or working in Madrid. Rebuilding the workforce is going to take years. You can't just parachute in 50,000 American expat workers without causing massive social unrest and inflation in the local economy. Okay, so why should a viewer in Chicago, London, or Toronto care about heavy crude in the tropics? Because this situation is a binary event for the global economy. It's going to go one of 2 ways, and both will hit your wallet. Scenario A, the bull case. The US effectively colonizes the Venezuelan energy sector. Security is established. The oil majors capitulate and start investing. The result, within 2 to 3 years, we see an additional 1 to 2 million barrels of oil hitting the market daily. Inflation, this is a massive deflationary force. Oil is the primary input cost for everything: shipping, farming, manufacturing. If oil drops to $40 or $50 a barrel, inflation is crushed. The Fed can cut interest rates aggressively. Your portfolio, this is the Goldilocks scenario for the S&P 500. Lower costs, lower rates. Specifically, US refiners would see their margins explode. They get cheap, heavy Venezuelan crude, process it, and sell the diesel at a premium. This is a buy signal for downstream energy stocks. Scenario B, the bear case. The US blockade continues, but the oil majors refuse to invest due to safety risks. The Venezuelan economy collapses completely into chaos. Insurgencies target oil infrastructure. The result, supply shocks. The global market loses what little Venezuelan supply remains. Uncertainty spikes. Geopolitics, China and Russia retaliate, perhaps by squeezing supply elsewhere or creating trouble in the Middle East. Your portfolio, oil spikes to $120 plus. Inflation roars back. The Fed has to keep rates high or even hike them. Growth stocks get hammered. The cost of living crisis deepens. There is also a black swan risk here, the US dollar. By weaponizing the dollar and the US banking system to seize a country's assets and enforce a blockade, the US is telling the rest of the world that their sovereignty is conditional. This accelerates the move by BRICS nations to trade in currencies other than the dollar. Long term, this weakens the dollar's status as the global reserve currency. If the dollar weakens significantly, import prices in the US skyrocket. So, where do we stand? We are witnessing a high-stakes poker game. Trump is betting that he can bully the oil market into submission. He is betting that the allure of 300 billion barrels of oil is strong enough to make Exxon and Chevron forget the past and ignore the risks. He is trying to force a timeline that geology and economics simply don't support. You cannot rebuild a 70% collapsed industry in a few months. It takes decades and billions of dollars. For the American consumer, the promise of cheap gas is the carrot. But the stick is a potential geopolitical disaster in our own hemisphere. Here is my forecast: expect a standoff. The oil majors will make polite noises, sign a few memorandums of understanding, and maybe commit a few $1 million to study the feasibility. They will stall. They will wait to see if the Rodriguez government survives. They will wait to see if the US Navy can actually secure the fields. Wall Street hates uncertainty, and right now, Venezuela is the definition of uncertainty. What should you do? Watch the crack spread, that's the profit margin for refiners. If Venezuelan oil starts flowing to the Gulf Coast, refiners are the first winners. Watch the US dollar index. And most importantly, watch the news coming out of Caracas. If we start seeing attacks on infrastructure, or if the acting president is removed, all bets are off. The era of passive energy markets is over. We are back to the era of oil imperialism. And whether you drive a car or own a stock, you are part of the game. Thanks for watching. If you want to understand how other geopolitical shifts are threatening the US economy, click this video here where we break down the debt crisis. And don't forget to like and subscribe if you want to stay ahead of the curve. I'll see you in the next one.